Dollar cost averaging, or DCA, is an investment strategy designed to reduce the impact of market volatility on your investments. Instead of investing a large sum of money all at once, DCA involves investing fixed amounts of money at regular intervals, regardless of the market conditions. This approach helps to mitigate the risks associated with market fluctuations and can lead to long-term growth. Let's illustrate how DCA works with a practical example. Imagine you want to invest £500 monthly in a stock mutual fund. This means that every month, without fail, you set aside this amount to invest, regardless of the market conditions. With DCA, you would invest this fixed amount on the same day each month, regardless of whether the market is up or down. This disciplined approach ensures that you are consistently putting your money to work, taking advantage of the market's natural fluctuations. For example, if the mutual fund costs £25 per share this month, you would purchase 20 shares. This straightforward calculation shows how your investment buys more shares when prices are lower. Next month, if the price drops to £20 per share, you would buy 25 shares. This means that your fixed investment amount allows you to acquire more shares when the price is lower, maximizing your potential for future gains. By investing consistently, you buy more shares when prices are low and fewer shares when prices are high, ultimately averaging out your investment cost over time. This method helps to mitigate the impact of market volatility on your investment portfolio. This approach stands in contrast to lump sum investing, where you invest a large sum of money all at once. Lump sum investing can be advantageous if the market is on a consistent upward trend, but it also carries the risk of investing a large amount just before a market downturn. While lump sum investing can yield significant returns in a consistently rising market, it exposes you to higher risks if the market experiences a sudden downturn. The timing of your investment becomes crucial, and poor timing can lead to substantial losses. DCA, on the other hand, spreads out your investment risk, making it a more conservative approach, especially for long-term goals like retirement planning. By investing smaller amounts regularly, you reduce the impact of market volatility and can build a diversified portfolio over time. This strategy is particularly beneficial for those who prefer a steady, methodical approach to investing, ensuring that they are not overly exposed to market fluctuations at any single point in time. Additionally, DCA can help to instill a disciplined investment habit, encouraging investors to save and invest regularly. This can be particularly useful for new investors who may be intimidated by the complexities of the stock market. By breaking down investments into manageable monthly amounts, DCA makes it easier to stay committed to your financial goals. In summary, dollar cost averaging is a powerful investment strategy that can help you navigate the ups and downs of the market. By investing a fixed amount regularly, you can average out your investment costs, reduce risk, and build a solid foundation for your financial future. Whether you're saving for retirement, a major purchase, or simply looking to grow your wealth, DCA offers a practical and effective approach to achieving your investment goals. One of the primary benefits of DCA is its ability to reduce the impact of market volatility. Market fluctuations are inevitable, and trying to time the market perfectly is nearly impossible, even for seasoned investors. DCA takes the guesswork out of investing by allowing you to buy more shares when prices are low and fewer shares when prices are high. This strategy can potentially lower your average cost per share over time, leading to potentially higher returns in the long run. DCA allows you to average out the cost of your investments over time, potentially reducing your risk. When you invest a lump sum, you're essentially placing a bet on the market's performance at a single point in time. However, with DCA, you spread your investment over time, buying at different price points. This approach can be particularly beneficial in volatile markets, where prices can fluctuate significantly. Benefit 3. Encouraging consistent investing habits. Dollar cost averaging promotes disciplined investing, encouraging you to invest consistently, regardless of market conditions. By automating your investments, you're less likely to be swayed by short-term market fluctuations or emotional decision-making. This consistency can be crucial for long-term financial success, as it helps you stay the course and weather any market storms that may arise. Benefit 4. Minimizing emotional decision-making. Investing can be an emotional roller coaster, and fear and greed can often cloud our judgment. When markets are soaring, it's tempting to invest heavily, hoping to ride the wave of a bull market. Conversely, when markets plummet, fear can set in, leading to impulsive decisions to sell investments at a loss. Dollar-cost averaging helps to remove emotion from the equation by encouraging a systematic and disciplined approach to investing. By investing consistently, regardless of market sentiment, you're less likely to make rash decisions driven by fear or greed. Potential drawbacks: lower returns in a rising market. While dollar-cost averaging offers numerous benefits, it's essential to acknowledge its potential drawbacks. One of the primary concerns is the possibility of achieving lower returns in a consistently rising market. This strategy involves spreading out your investments over time, which can be advantageous in volatile or declining markets. However, in a market that is steadily climbing, this approach might not be as beneficial. One such drawback is the possibility of lower returns in a consistently rising market. When the market is on an upward trajectory, investing a lump sum at the beginning would allow you to take full advantage of the growth. This means that your entire investment benefits from the market's rise, potentially leading to higher returns. If the market steadily climbs upwards, investing a lump sum at the outset would yield higher returns compared to dollar-cost averaging. This is because, with a lump sum investment, all your capital is working for you from the start, capturing the full extent of the market's gains. This is because, with dollar-cost averaging, a portion of your capital would be sitting on the sidelines, waiting to be invested, potentially missing out on early market gains. This waiting period can result in missed opportunities, especially in a market that is consistently moving upwards. However, it's crucial to remember that predicting market direction with certainty is impossible. The future movements of the market are inherently unpredictable, and what seems like a rising market today could experience a downturn tomorrow. This unpredictability is why many investors choose dollar-cost averaging, despite its potential drawbacks. While a lump sum investment may outperform dollar-cost averaging in a bull market, it could also lead to significant losses if the market experiences a sudden downturn. A sudden drop in the market can be devastating for a lump sum investment, as all the capital is exposed to the market's volatility at once. Dollar-cost averaging, on the other hand, offers a more conservative approach, potentially mitigating losses in a market downturn. By spreading out investments over time, it reduces the risk of investing all your capital at a market peak, providing a buffer against sudden market drops. This strategy can be particularly appealing for risk-averse investors looking for a more stable investment journey. Conclusion: dollar-cost averaging, a reliable strategy for long-term success. Dollar-cost averaging is a powerful investment strategy that can benefit investors of all levels, particularly those new to investing or those seeking a less risky approach. This method involves investing a fixed amount of money at regular intervals, regardless of the market's performance. By doing so, you purchase more shares when prices are low and fewer shares when prices are high, effectively averaging out the cost of your investments over time. By investing consistently over time, dollar-cost averaging can help you ride out market volatility, average out your investment costs, and potentially achieve your long-term financial goals. This strategy is particularly useful during periods of market uncertainty, as it reduces the emotional stress of trying to time the market. Instead of worrying about whether it's the right time to invest, you stick to a disciplined plan that can lead to more stable returns over the long run. While dollar-cost averaging may not yield the highest returns in a consistently rising market, its ability to mitigate losses in a downturn makes it a valuable tool for long-term financial success. This approach is especially beneficial for those who are risk-averse or new to investing, as it provides a structured way to enter the market without the fear of making a large investment at the wrong time. Remember, investing is a marathon, not a sprint, and dollar-cost averaging can be your steady and reliable partner on your journey to financial freedom. By maintaining a consistent investment schedule, You can build wealth gradually and steadily, celebrating financial milestones along the way. Whether you're saving for retirement, a child's education, or another long-term goal, dollar cost averaging offers a disciplined and effective path to achieving your financial dreams.